Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, welcome to Cut to the Chase. Today is Wednesday, the 19th of August, and my name is Fook Hien. Earlier this month, in this podcast series on the 5th of August, I discussed the key drivers for the equity market to watch out for in the month of August. And one of the drivers that I said we need to monitor closely is long-term rates, as they have been moving higher. Our backtesting shows that for every 25 basis points increase in the cost of capital, equities face a potential valuation impact of 3 to 4%. The good news, though, is that we believe earnings growth will have sufficient buffer to drive equities higher over 6 to 12 months, despite any adverse impact from higher rates. Nonetheless, that doesn't stop the market from feeling nervous, as we saw last night when the S&P 500 fell by 0.7%, with concerns over the rising cost of long-term debt. There are other reasons too for this weakness, including geopolitical uncertainty, weakness in the technology sector, as well as profit-taking and lower liquidity seasonally at this time of the year. As long-term borrowing costs rise, it has the effect of slowing down economic activity. However, I want to talk about one potential beneficiary from a rise in borrowing costs, and these are, of course, the banks, which are lending out the money. As long-term rates rise, banks can earn more from the same dollar that they lend out. Reality is, of course, much more complicated because the cost of financing is also rising for the bank, meaning they have to pay more to obtain the dollar that they want to lend out. Furthermore, as economic activity slows with rising rates, the volume of loans can be expected to be lower. And finally, when borrowing costs rise, the likelihood of distress from borrowers rise, so banks may need to set aside more provisions for loan losses to account for borrowers who have difficulty repaying their loans. Having said that, when bank management report their financial results, higher rates are generally seen as a tailwind for the bank's net interest income. In our house view, currently, the financial sector is one of our preferred sectors across the regions. Specifically, we are overweight on the US financial sector, the Japan financial sector, and the Euro area financial sector. So rising rates are one of the drivers for our preference for the financial sector in Japan and the Euro area, as we expect one more rate hike from the Bank of Japan and from the European Central Bank by the end of the year. In the US, our positive view on the sector is driven more by strong capital market activities, with a lot of financing deals to fund the massive AI investments and a recovery in merger and acquisition deal activity. We expect this growth in fee income from capital market activities to come on top of resilient net interest income. Given that financials is one of our preferred sectors across the regions, we have been receiving questions about how much exposure investors should have to that sector within a portfolio context. Currently, the financial sector accounts for approximately 17% of global equities. Using a multi-asset portfolio, such as our CIO Foundation portfolio for a balanced risk profile, financial sector equities would then represent around 9% of total portfolio exposure. While financials may not offer the same level of earnings growth as the technology sector, the financial sector's steady low to mid-teens earnings growth profile makes it a core holding for investors amid buoyant markets, elevated interest rates, and reasonable valuations. That's all I have for today. Thanks for listening, and I look forward to speaking again with you soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.